Let me ask you a quick question. How do you feel when you see a stock make a huge move up or crash lower on major news, but you're sitting on the sidelines not catching any of it? Obviously, no trader enjoys being in that situation. All the what ifs and the could haves consume your thoughts. But the reality in trading is that most major news reports are unpredictable for the independent trader, and you have no edge in trying to guess which way a stock will go. But what if there are a way to eliminate having to guess the direction and still be able to capture a major move in a stock if it occurs, regardless of whether it goes up or down? If that's something you'd be interested in, then this video is for you.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Okay, so undoubtedly 2022 will go down in history as the year of surging inflation, and anyone involved in the markets in any way knows that the market is going to respond dramatically to any news involving inflation, whether it's the monthly consumer price index announcement or any news about how the Fed will be tightening monetary policy to try to quell the surging inflation that's plaguing the worldwide economy. And so, as every trader knows, along with dramatic price movement becomes dramatic trading opportunities. And the unique thing about using option strategies to play dramatic market moves is that with the right strategy, you won't need to predict how the market will react to a major inflation report in order to win the trade. You see, there are, in fact, option strategies where you'll make a respectable amount of money in most cases, but at the same time, you set yourself up for a potentially spectacular win if the trade plays out in a certain way. So in this video, we're going to be teaching you a strategy that works just like that. But before we delve into that, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use all the time, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. In order to teach you this strategy for playing major inflation reports like the monthly CPI announcement, we've got to make sure that you understand how index options work, because those are the kinds of options we'll be using in this example. Now, some of you may not fully understand how index options work, so we're going to do a really quick review of them. And for those of you familiar with how they work, just hang in there. This is going to be really quick, and then we'll just jump right back into teaching you the strategy. All right, so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known the strike price of the option on the day that the option expires. If the index does close above that price on expiration day, then the call buyer gets $100 in cash per point that the market closes above that call strike price. A put option is the opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So, for example, if an index closes at 4,032, then the 4,000 call would pay off $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 4075 call would expire worthless, as the index didn't close above 475, so the call seller he just gets to pocket the premium he collected. And the puts are just the opposite. If the market closed at 40.32 again, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. Okay, so with that said, let's head back to September 15th of this year, which is 2 days after the last monthly CPI report was released. And as you can see, after the SPX index had gotten below 3650 in June, it rallied back, and just a few days before the CPI report was released in September, it was sitting up over 4100, after which the market reacted negatively to the CPI report, resulting in a drop back under 4,000. And so looking forward to the next CPI report, which was scheduled to be released on October 13th, about a month later, let's say that a trader decided that he wanted to set up a trade that would make a modest amount of money if the market rallied off of the next CPI report to be issued in October, but could make a great deal of money if the market were to sell off after the report. Now, with most trading instruments, that wouldn't really be possible, that you could make money on the trade whether the market rallied or sold off. But with options, there's a strategy that actually works that way. And so let's take a look at an example of how this could have been structured. So let's say that on September 15th, we pulled up an options chain expiring a few days after the next CPI report, which is coming out in October. And that would be the October 14th options chain. And we went ahead and bought 10 of the 3640 puts, which are located just above the lows for the year, which is intentional, as you'll see later. And at the same time, we sell 20 of the 3590 puts expiring the same day, which is located 50 points below. And finally, we buy 10 of the 3510 puts, also expiring that same day. And so when he executes this particular formation of options, it's called a broken wing butterfly to options traders. And it's a very useful trade once you understand its dynamics. Now, let's first off dig into the cash flow of the strategy when you enter it, so you'll understand exactly how this works. So let's start out with the options we sold, those 20 puts down at 35.90. And as you can see from the calculation, we sold those for $20.35. And as we discussed earlier, each point below 35.90 is worth $100. So you multiply that price by 100, and we sold 20 of them. And so when you multiply it all out, the result is we actually got in $40,700 in cash, and that flows right into your account. But then remember, we also bought 10 of the 3640 puts, which, as you can see from the calculation, cost us $26,250. And we also bought 10 of those 3510 puts, which cost $13,850, using the same kind of logic. And so the resultant cash we collected by entering into this trade was $600. And your broker will require you to have at least $29,400 in your account in order for you to enter into this trade in the first place, which is also the trade's worst case scenario. The way that this trade was designed was intentional. You see, the lowest closing price of the year for SPX was 36.66, and you'll notice that all of the options comprising this broken wing butterfly trade, the 35.90, the 36.40, and the 35.10, all of those are located below that 36.66 price for the year. And so if the index simply closes above its lows for the year, then all of the options comprising the broken wing butterfly expire worthless. And the trader simply walks away with that $600 that he collected initially when he entered into the trade, because there's no value to a put on expiration day if the strike price of the put is located below the index's value, as we discussed earlier. But that's not exactly what happened in this case. What happened actually in this case is a lot more interesting. And that is that we need to move forward to the day that the CPI report was issued, which was October 13th. And as you can see, the market rallied strongly off of the report, closing up at 36.69 that day, which happens to be the day before our broken wing butterfly trade expires. So this rally gave us a wonderful opportunity. You see, at the end of that day, the trader closed almost the entire position, selling 7 of the 3640s, leaving 3 of those, and buying back all of the 20, 35, 90 puts he sold, and selling all of the 10, 35, 10 puts that he originally bought. And so when he does that, the result is that the only remaining remnant of the original position is actually those 3 long 3640 puts that he still owns. And in a minute, you'll see why he left those 3 puts in place and didn't sell those off. But before we do that, let's first see where that leaves us from a cash flow standpoint after he traded out of most of the position the day before it expires. And so starting with the original cash flow we received when we first entered into the Broken Wing Butterfly, that original $600, we then add to that the proceeds of selling 7 of the 10 3640 puts, which on that day were selling for $15.75. So as you can see from that calculation, we received $11,025 for those, but we had to turn around and pay $11,400 to buy back the 20 puts at $35.90. And then finally, we received $11.50 for selling off all of the 2510 puts we had originally bought, resulting in a new positive cash flow for the trade in the amount of $13.75. And that's significant because remember, we originally collected $600 for entering the trade, but now our cash flow has increased to $13.75. And what's so important about that is that the trade has now become risk-free. Why? Well, think about it. The next day when the trade expires, if the index closes above the 3640 puts, then they just expire worthless and the trader just pockets the $13.75 in cash that he's collected. But if the index closes below 3640, then those puts will settle with some value, as we discussed earlier, $100 per point below the strike price of the option for each of the 3 options. So in other words, at any price, the position will have a profit of at least $13.75 with the potential for more if the index closes below 3640. So if you think about it, the trade is now risk-free, and those 3 3640 puts are kind of like lottery tickets should there be a sell-off the next day. And so let's move now to that next day. And as you can see, the index closed at 3583.07. It sold off, in other words, and that's a 56.93 points below the strike price of the 3 3640 puts that we kept open. And so at this point, those final puts can be valued. And as you can see, starting with that positive cash flow that we had accumulated already during the course of the trade, then all we do is simply add to it the settlement value of the 3 remaining puts. And the way you figure that out is that you take the put strike price of 3640, you subtract out how much that option closed in the money, which as you can see is 56.93, and then you multiply that by 100 because those are worth $100 per point. And of course, we retained 3 of those. And so when you multiply it all out, you end up with an additional $17,079 for a grand total of positive cash flow of $18,454, which comes out to a return of 62.7% in just a month. And so what I'd like you to take away from today's video is that the Broken Wing Butterfly strategy, if you locate it intelligently, it provides an incredible opportunity for a trading win in its original form. At the same time, depending upon how the trade plays out, there's a way that you can pull all of the risk out of that trade, as we did in this case, by trading out of most of the trade while leaving a few puts in play as what we would call lottery tickets, should the market take a hard move downward, as it happened to do in this case, resulting in a spectacular outcome. But regardless of whether that lottery ticket comes through for us or not, the fact is that the trade had a very high probability of winning as originally structured and turned risk-free with an even higher floor of profit towards the end of the trade, while retaining that lottery ticket potential, which, as it did in this case, will come through now and then with sometimes amazing results. As you become a more experienced options trader, you'll begin to recognize these kinds of opportunities regularly. Now, just to remind you, if you're serious about your trading, you'll need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.
So now you know how to trade a major breaking news event, which is super important for this current market environment that has numerous market-moving inflation reports. But this strategy won't get you to consistent profitability by itself because these reports don't happen daily or weekly. So what do you do if you want a more steady strategy that can bring consistent income? Well, that's answered in the video that's appearing on your screen right now, and it has to do with trading weekly options. So make sure to check it out if becoming a consistently profitable trader is your goal.